Stay tuned.
Stay protected.
Stay focused.
Stay connected.
There's a lot of different types of HELOC products that are now on the market, some of them geared towards velocity banking, and that's really good news.
This is probably the largest asset you will ever have in your life.
Right.
Here's some direction and some instruction on how to leverage this vehicle so that you can help yourself, help your family, accomplish your goals. We're not educated that way.
We use a strategy to pay off our home in 4 years.
Validation of your retirement account says what you thought was a retirement account is no longer one.
When I tell you, you're going to be shocked to learn. If you didn't come from a wealthy family,
You can make sure a wealthy family comes from you. So it starts with pay yourself first, today,
Yeah, starting today.
right now. Put your money in somewhere secure. It's about the ability to not lose. I will take base hits all day long versus winning and losing. Somewhere secure, compound your money, and then you leverage OPM, other people's money, to exponentially grow it. That's how you generate wealth.
So whether you're joining us to crush debt or build wealth, time is the most valuable asset.
and we're so grateful that you're spending your time here with us.
Welcome. Good evening. Get in here, jump in the chat. We have Cynthia, Nathan. Hi, Nathan.
What's up, Nathan?
Yeah, it's
Hey,
great
Cynthia.
to see you. Yes, and welcome, Cynthia. Everyone else who is watching, please jump in the chat. If you're watching the replay, jump in the comments and give us your feedback. Tonight, we're talking about fees. Now, we've gone through this somewhat before. We've done some pretty good deep dives.
Oh, yeah, absolutely. And what it is, there are these moments where I get these reoccurring questions, and that just tells me, you know what, maybe it's time to break down, one of these topics. And so for the last few weeks, we've been covering a leveraged IUL, how it grows, the power that it has, all of those great and wonderful things. And the comment that I got was, you keep talking about how good it is, but what about the negatives? Like, you never talk about fees. And it dawned on me, I graze over them. I say they exist, but I've never really broken down, or lately I haven't broken down what that actually looks like. So here's the opportunity.
Yeah,
Let's dig into it.
Because I'd say you have broken down
Many
fees
times.
before. Yeah,
Many times.
yeah. But I think for the majority of people, one, if you don't know what your fees page looks like on your current policy, go grab your policy and jump in on this live stream.
Turn to the fees page.
Yeah, or if you can find it. If you can't find it, then this is a great place to take notes and then take that back to, whoever it is that helped you with your policy. This is the second thing. This is for you if you are interested in learning how a vehicle like this grows, why it grows, and wanting to understand, like you were saying, what are the downfalls? What are the pitfalls? What are the things that I should be more aware of? And how do I know if one performs better than the other when there's so many there's a varying opinions out there, smorgasbord of opinions on which one is best? Well, if you know how to read a policy, if you know how to dissect this information, and you're not just having to take the opinion of somebody else to, in the meantime, then you'll be a better judge of what is best for you. So that's two. Third one is if you, like I said, if you currently have a policy, then
Go get it.
yeah.
But on that note, though, I think what's interesting to me is we do so much, like we love to deep dive. We love to dig into the details and peel back layers, jump in rabbit holes and all those kind of fun things. And I just wish we would do more of it. For instance, we should be having this conversation about your mortgage. We should be having this conversation about your retirement account. Like, we should be having this conversation about everything, because when you peel back the layers, like, hey, I get it. This strategy seems like it's new, but it's really not. Been around since 1997. But the question I get is, but what about the fees? And then I ask, well, what do you currently have in place? Well, I've got this IRA, I've got this 401k, I've got this 403b. And my question goes, well, tell me about those fees.
Yeah, because if you get me started on this, I already tried to do this comparison. I was trying to build this chart that would make sense for everyone, and I didn't want to confuse or derail the conversation tonight, but I don't know if I'm going to be able to hold back on it, because that is exactly my position when we were starting to go through okay, well, what is it that we prepare? How do we present this information so that it makes sense to people? We do our best to try to do that so that we can educate from a different what do you call it? Approach.
Yeah.
Yeah.
Right.
Just to be more effective in educating. So when I was thinking about this, I absolutely was thinking about the fees people constantly are comparing, well, 10% is worse than 3% interest rate, right? So clearly, just off the top, it's a no for me because I'm not going to do this HELOC strategy you guys are talking about if I'm going to have an 8% interest rate when I have a 3 or 4%. Even a 5% would be better than that on a 30-year mortgage. I would rather make extra payments. And when you hear, when you can see it, when you can do the math and you understand how fees are designed, how they are, how they impact the overall strategy or total that you would pay for something, for a good or service or whatever the case is. And then you can do the long math on this. When you hear people say these things like, off the top, 3 is better than 8, you are going, please do the math all the way through. It's no different than what we're going to talk about tonight. Because if you do not have a commitment to a strategy and you are just doing surface math and jumping from this to that based off of the surface math, you are robbing yourself before anybody else can claim, make that claim with anybody else robbing you. And that is really what it comes down to. But I don't think it's your fault if you are jumping strategies and you are not able to make commitments, because how do people commit to something if they know that it's committing to going down the wrong road enthusiastically and then they learn something different later? We don't know what we don't know, but as long as you're learning, as long as you're here to learn, you're going to get better. Things are going to get better. And things got better for us when we realized we didn't know what we didn't know, and we went in search of finding it. And so that's all that we share here on our channel are the things that we have implemented into our building our machine, right?
See, we need a let her cook button, because I was looking for something and I just don't have anything. Because you're absolutely correct.
Yeah.
It's we don't know what we don't know, and all we do is absorb the information that's been provided to us. Meaning, most of us head down this path of, I've got to get this mortgage, or I've got to get this term policy based off the education that's been provided to us or drilled down in us from our parents or Dave Ramsey, what we watch, whatever those issues are. But when you start peeling back the layers around why things are the way that they are and why we've been conditioned to do the things that we do, what you learn is it's by design.
Yeah.
Like all of the actions that we're taking are by design. It's to keep us in the position that we're in, and that is broke. And so the objective is to simply become the people who are focused on making sure we stay broke. I want to become the bank. I want to become the life insurance company. I want to become that financial advisor. I want to do what they do. I want to put my money where they put their money. And I want to have the access and leverage and flexibility that they have, so that I can do the things that they do, so that I can generate, build wealth, and guess what? Then teach my lineage, so we can get ourselves out of that position of being sheep. I think it's all by design. And you're right. It is not your fault.
Right.
If we walk through something tonight and you go, why doesn't mine do blah? Let's jump on a call and let's talk about it, because it is not your fault. And how about this? I will go as far to say, in most cases, it's not even the guy that sold it to you's fault.
Right. Because a lot of the times they're just parroting what they were told. Yeah.
That's it.
Yeah. And can you guys hear us okay, by the way? Because we can't verify that. And sometimes we have those issues. I would assume that we would be seeing that. Okay. I don't think we have any issues. Just off the top, want to make sure we clear that. The problem with why we have to educate ourselves is because the stuff was intentionally removed from schools or never put in effectively, right? And there is a reason for that. But you're right. The other side of this problem is that now we have people in these industries, and it's not just life insurance.
Right. It's not.
It's financial planning in general. It could be in your business planning. It could be in the person who helps you with your taxes. They could be subscribed to ideas, this indoctrined into the same system that was designed to not actually help you.
Right.
And that's the belief system, the underlying belief system that is lines the belly of our nation, our economy, right? And this what is it? There's a term for this, hyper it's a term that, and it just has left me right now, but this concept of they knew that this was a problem back in the 80s. They understood where it was we were going as an economy, as a nation. They knew this, but it was easier to pretend that things were going to stay the same, and that the same systems, and that the same vehicles, and that the same programs, the same beliefs about what's possible for the future. It was easier for them if they kept promoting these same ideas as if it's okay to still believe. If you think about it, when the 401k came out, what was the goal then? $1 million. It has not changed.
Right. Very true.
And that's why it's so important to take note of what are those factors and to the degrees that they impact you, because it does impact your results. And it is the reason why that number has not changed in decades, because it's not achievable still to this day, maybe more achievable back then than it actually is now. Because even if you did hit $1 million in your account, because of inflation, you could not survive on what you would be able to, that would yield in income. You would not be able to survive on that as a retirement income. So this is why we have to wake up, and we just have to learn for ourselves. We can't wait for this to become a trend. We can't wait for this to be put in schools. We can't wait for this to become table dinner conversation. We just have to move forward. So I hope that you enjoy what it does, the series in how you've been rolling out, breaking down how to read a policy so that you can read your own, or that you could understand to read one that you'll be getting soon.
So, couple things. There will be math, but it won't be anything, I'll call it, too strenuous or too complicated. It's basic math that I just want to walk through to make sure we understand how and why these figures came about. And I am going to spend some time comparing, I'll call it, not necessarily apples to apples products. It's meaning I am going to use traditional retirement accounts compared to life insurance based products, and how the fees in the two stack up. And so we'll kind of dig into some of those details. But other than that, like I said, this is one of those opportunities where if you do have a policy, it doesn't matter the type of policy you have, go get it and let's compare.
Can we do one thing before you go?
I'm listening.
Can I just swap this around?
Oh, do whatever.
Yeah, I didn't notice that before. I just want to make sure.
Get me right.
Yeah, okay. Now you're good. All right, let's get into it. Let's go to the vibe board.
Let's do it.
Here we go.
1, 2, 3.
The goal should be, where can I achieve exponential growth? Exponential growth.
Let's just get into it. Let's just get into it.
Right. And can you hear me okay? Everything
Yep,
sounds
I can
all right?
hear you. Yep.
Make sure, before I get too deep off into things, to make sure the comments stay the same, that everybody's okay and they can hear me just fine. So again, the main objective for today is to dig into fees and fee structure. But how about why? Why is this even a conversation to be had? Well, our focus is to make sure that all of the items that we educate around, whether it's a self-directed retirement account, like having control over your IRA or 401k to be able to invest in non-traditional investments, or maybe it's velocity banking, where the whole idea behind velocity banking is just to free up cash flow. Why? When you free up cash flow, you have now an opportunity to take that cash flow and put it to work. And it allows you to be able to access and or qualify for a different type of debt tool to do what? Again, allow you to increase and build your cash flow so that you can put it in other vehicles that can help generate wealth. The whole goal is control. And majority of the products that we are served today give us very little control. Whether it's talking about our traditional retirement accounts that come from our employer, we all have very little control over them. Whether it's going to a bank and getting a mortgage, we have very little control over this largest asset that we have as it relates to our mortgage, or even if it's basic life insurance. Most of us have no idea that if you just simply structure the same product differently, you have more control over it to be able to access and do whatever it is you want. Most of us have no idea as to how and or why it works this way. And so the objective today is just kind of walk through some of those actions as to what it looks like. And to do that, what I wanted to do was highlight a few things. One, we're going to break out the fees inside of a self-directed retirement account to help understand what that looks like. And I think what we're having a little trouble with the vibe board. Is that correct? So give us a little bit to kind of pull that together. But the bottom line is what we're going to do is rebuild or break down how the fees function inside of a traditional retirement account like a 401k. And then I break down what that fee structure looks like. And then we're going to compare that against the same fee structure inside of a traditional retirement account. Like, and then compare and contrast that to an IUL and what that function looks like over time. Let's see, hold on. Good.
Is it off again?
Yeah, it's off. Hold on, let's see if we can get the vibe board going. Mm-mm. Okay, it's on. All right, give me just a minute to load up things, get things back in order. Let's see here. All right,
Okay, now we can see it now.
perfect. All right, give me just a minute to move things around.
And here, while you're doing that, no. Okay, well they can hear me.
Yep.
Here's the point. The point is, here I'll just go back. The point is here of what we're dealing with, just people who are like, are you kidding me with these tech issues? We can't throw enough money at this problem to fix this because we've contacted all the tech people we can contact. We've gotten all the things they said to get to fix these things. And then it seems like they don't talk to each other. So we've had to be probably the guinea pigs for some of the problems and the gaps in tech. And that's what we've been busy and super frustrated trying to fix for you guys because it is a disruption for you guys. So just to let you know, it's not that we're not trying to solve this problem, have less tech issues. It has literally been like a full-time job over here talking with different tech supports for whatever the thing is. But we're getting there. So cheer us on. That's what we need. We need people to cheer us on.
Okay, let's rock and roll.
Think we're ready to go?
Yeah, let's do it.
All right.
All right. So to jump right in, we've kind of covered a few things. And one of it was, hey, with this leverage IUL, again, it's all about where you get it from, who creates it, and what that structure looks like. And that structure needs to be a max funded option B IUL with leverage. But again, the consistent thing that I've gotten over these last few days was, what about the fees? Like I've talked about all the great and wonderful things that it's able to do, but I haven't really dug into the fees. And this is where I struggled this week because if we're going to talk about fees, then let's talk about fees. Meaning it's not just the fees inside of a life insurance-based product, it's fees in general. Because do you fully understand how fees function inside of your policy? And in addition, when we're talking about getting a policy, it's rooted in what is the goal. And in most cases, the goal is about income, some form of income. And it's not income tomorrow. It's not income today. It's income when I need it. When I need to access the cash value inside of my policy, I want it accessible. And so if the goal is income, if the goal is having a vehicle that you can leverage and use to be able to do what you want, you first have to look at what do you have today that's going to allow you to do that? And then what is it going to take? What is it going to take to be able to produce what it is you want? And so I'll zoom in on this to make it a little bit bigger. But what I wanted to do was just dig into, again, fees, policy fees. But I wanted to do it by comparing it against traditional retirement accounts. So when we look at traditional retirement accounts, how does that compare inside of a whole life policy? How does that compare inside of a leveraged IUL? These are the three main vehicles that we've been talking about over the last few weeks. Again, whether we're talking IRA, 401k, 403b, TSP, it doesn't matter. If you have a financial advisor involved and it is you're using this product to purchase mutual funds, stocks, and bonds, you in some way, shape, or form have some fees associated with this product, and 9 times out of 10, they're in the form of what's called compounding fees. As it relates to life insurance in general, whether it's whole life, IUL, variable universal life, it doesn't matter. The fee structure is traditionally the same, and that is they are front loaded. The question is it a high front load fee or a low front load fee? So we're going to dig into front loaded fees as well, but these are the three pieces that we wanted to discuss. And so let me start with, I think I'm going to start with start with an IUL. And so when we start talking about fees, and again, I know it's pretty small on your screen, but when we're talking about compounding fees versus front loaded fees, I want to set the stage. And let's first set the stage with, we're talking about a 25-year-old, and we're putting in $500 a month. Pretty simple, $6,000 a year for a 25-year-old, and we're talking about someone who is in great health. So what does that look like inside of a traditional policy that is designed properly? And again, max funded, option B, IUL with leverage. Well, in this case, it's a $6,000 a month policy that you're contributing, and there are fees associated with it, and there is growth. We're not going to spend any time talking about growth today. I want to focus the attention here. There are mainly 3 buckets of fees that we focus on. Those 3 buckets of fees are the premium charge, the expense charge, and the cost of insurance. And I want to be clear about something. I'm going to focus my attention at the moment on the premium charge and the expense charge. Why? To me, these are the only expenses associated with this account, and I want to compare these expenses with the expenses in other products. The cost of insurance, to me, is a cost of doing business, meaning what is it that we're buying? Remember, what's the goal? The goal is I wanted a product that I can use to generate income over time. Okay, if that is the goal, then what you're saying is this life insurance policy is an asset. What is the cost of using or having that asset? Well, in order to qualify for a product like this, which has a death benefit of about $178,000, in order to qualify for it, you do have to be healthy. There is a cost to the privilege of having this asset, and that cost is cost of insurance. I'll dig into this later, but I wanted to just focus here on the premium charge and the expense charge. And again, looking at it mathematically, I'm putting in $6,000 a year. That premium charge is $202, and the expense charge is $288. When you add the two together, 202 plus 288, we're talking about what was that? 490? Yeah, $490 in fees being the year one fee structure for this policy. But let's drill down a little bit further. What is the premium charge? What am I saying when I say a premium charge? What I'm saying is there's a dollar amount that you're contributing, in this case, $6,000 every year. And then there's a premium, there's a cost of doing business in this identified as the premium charge, meaning it's what the life insurance company is charging up front. And that upfront cost is $202. And the expense charge itself is where I would say your commission is located, the cost of insurance, the cost of the exam, the cost of underwriting, the cost of the maintenance inside of your policy would be considered the expense charge. Here, if you notice, the premium charge is consistent as long as you're contributing into this policy. However, if you stop contributing into this policy, let's say at year 10, if you stop contributing into this policy, then the premium charge will go away. So there's really not much change to the expense charge other than it's relative. If you only put in $60, then or $600, then the expense charge would be $20. The bottom line is the premium charge and what it is you're contributing is fairly relative. It is based off the amount that you're contributing. If you stop contributing, the premium charge goes away. But the expense charge, this is where design matters. The expense charge has to be designed in a decreasing fashion. What that means is it may start out a certain dollar amount to start, but notice how it gets smaller after year 5. And then after year 10, it drops down to $60 per year. So again, the expense charge has to be decreasing in structure. If it's not, you should question why. And again, most people that I talk to who have either a whole life or some or even IULs in general, this page should exist in your policy. If it does not, the first question you want to ask is why. So again, if we were to contribute to this policy from age 25 to age 60, how much in expense charge would be contributed over that time? Well, till age 60, if we were to add up all of the expense and the premium charges during that period of time, I want to say it's about $12,000. My question to you is that a lot? Again, premium charge plus the expense charge contributed from age 25 to age 60 equates to about $12,000 in total. Is that a lot? But what do you have to compare it against? Well, what I wanted to do was compare it against a 1% management fee inside of a traditional retirement account. And again, using the same premise of let me pull this down, a 25-year-old contributing about $500 a month. Again, 25-year-old contributing $500 a month into a traditional retirement account. And in truth, it doesn't matter which type. IRA, 401k, 403b, doesn't make a difference. A 25-year-old contributing $500 a month. And I'm being very, I'm giving it the benefit of the doubt, meaning the advisor charging the advising fee is only charging 1%. And when it's time to start taking distributions, meaning at age 60, from age 25 to 59, it's a 1% fee. But from age 60 on, actually going to reduce that fee from 1% to half of a percent. So again, just to set the stage, 25-year-old contributing $500 a month, which is $6,000 a year. What most, if not all, traditional retirement accounts have is a compounding fee. How does a compounding fee work? Well, a compounding fee looks like this. It is solely based upon the amount you've accumulated inside the account at that time. So if you're putting in $500 a month, which is $6,000 a year, 1% of $6,000 is somewhere around $60. So it's a $66 fee to start. But as your account starts to grow, as that $6,000 starts to compound, that fee starts to compound with it. That fee starts to get bigger as the contributions in the account starts to happen. So if we look at the first 5 years, again, 25 to 30, first 5 years putting in $500 a month inside of a traditional retirement account compared to putting in that same $500 a month into a properly designed cash value life insurance product. What is the difference in the fees? And if we were to just simply look at the first 5 years, notice inside the traditional retirement account, the total amount of fees that would have been taken out or contributed to that account would have been about $1,000 compared to inside of a and again, I am saying a properly designed cash value life insurance policy with the 4 factors, meaning it's the best that you could possibly have. If we were to compare those two, notice how much higher the first 5 years are inside of a product like this. And this is where those who don't like life insurance, this is where they win. Because they would say, hey, see, you would really want your money sitting in some type of traditional retirement account wrapped up into mutual funds, stocks, and bonds so that, because look at the difference in fees. See, I told you the fees inside this product are less. But that's the short-term view. What does this look like over time? Because again, this 1% fee increases as your account starts to get bigger. Whereas it's a decreasing fee structure inside of a properly designed cash value life insurance product, which reduces as your account gets larger. So just from a math perspective, which one is better? A fee that increases as your account increases, or a fee that gets smaller as your account increases? And one other way to look at it. The goal is to use this dollar amount at some point in the future, probably somewhere around retirement. So when do you need the maximum amount possible? How about in retirement? And so the thought process is we would want a fee that's reducing over time. So when you, let me make sure I get everything into the shot. There we go. And so when you are contributing over time into a traditional retirement account, notice how that 1% fee continues to get larger. By age 59, a 1% fee on a $500 a month contribution into a retirement account, that 1 year is about $12,862 in year 59, compared to a traditional properly designed retirement account that's been on a decreasing fee structure. By age 59, we're talking $262 for that 1 year. When you add up all of the fees from age 25 to age 59 inside of a properly designed cash value life insurance product, we're talking about $10,500 in fees, compared to $133,000. This is where, if you've ever watched The Retirement Gamble, we talk about it a lot on this channel in general. If you've ever watched The Retirement Gamble, they talk about how your retirement account gets chewed up with about 2/3 in fees. This is how it happens. It happens because the fee is actually compounding over time versus getting smaller. And notice, this is prior to that actual retirement age. This is up until age 59. But what happens when you hit 59? Well, during that period, and as I mentioned, during that period of age 60 through age, let's call it 90, over the next 30 years while in retirement, as I mentioned, the advisor fee I'd say he kind of does you a favor. That 1% fee that was being charged while you were contributing into this account, your financial advisor goes, hey, I'm going to do you a favor and reduce that fee by half of a percent. And why? They're only doing that because, one, they understand that there's no more income coming in at that point. You're now going to start taking distributions. So they want to reduce the fees so you don't run out of money in retirement. Like, thank you. But what's the impact of that half of a percent being shaved off of that of the fee being compounded inside of your account? It still equates to another $170,000 in fees. So in total, from age 25 through age 90, you still would have spent, and I'll make this a little bit bigger, you still would have spent about $303,000 in fees. And if you were to play this out, if you were to simply take a 25-year-old, put $500 into the Vanguard calculator, it would spit out somewhere around $1.5 million in net worth. And in addition, if you would put the same $500 inside of for a properly designed cash value life insurance product inside the calculators you've seen me use before, it would spit out about $1.5 million. So they both produce about the same in net worth. But one produces significantly more as it relates to income. But again, staying here with the fees, in total, the premium and expense charge from age 25 to age 90 would equate to about $12,000 in fees, compared to $303,000 inside of a properly designed or a traditional retirement account. But there's one other piece that I want to make sure we highlight, and that is this. What about when you add back in the cost of insurance? And I'm going to walk you through what that looks like. But even when you add in the cost of insurance on top of the combined premium charge and expense charge, when you add back in the cost of insurance over that same period of time, the total fees inside of a properly designed cash value life insurance product is about 86 grand. Still, compared to this 303,000, which is better? Which one mathematically makes the most sense? And again, we spend a lot of time focused on, I think, the wrong things, because the key piece to all of this is, can the product that I have outperform the fees involved? But let's dig into the cost of insurance real quick. So again, there's 3 buckets of fees. There's the premium charge and the expense charge. And to me, these are actual fees, whereas the cost of insurance is simply the cost of doing business. Meaning, in order for this asset, in order for me to have access to this asset to be able to leverage and use for income over time, there is a cost to me doing that. And at age 25, that cost of insurance ends up being somewhere around $81. If you notice, and I'll make this larger for you, that cost of insurance actually gets smaller to start, and then all of a sudden it takes off again. It gets larger. What is that? What's being said there? Well, this is the life insurance company saying, hey, at age 25, that's a risky age, meaning the ability for you to still be here with us and not have done something to yourself, the likelihood of that happening is higher at age 25, 26 versus age 35. And so the reason the cost of insurance ends up getting lower during that period of time is because your risk reduces. But what happens as you get older? As you get older, your body starts to ache. You don't function the way you normally do. So your cost of insurance starts to increase as you get older. So it's a strange concept, but it makes sense because again, you are the asset. And as the asset, you age with time. And during that time, your cost of insurance or your cost to maintain this asset do increase. And so that's why the cost of insurance starts to increase as well. But notice, even with the cost of insurance increasing, and I think I stopped here at age 65, you would have accumulated about $12,036 in cost of insurance that's continuing to get larger. You play that out till age 90, that total dollar amount of $86,000 still pales in comparison to what a 1% fee that transitions to a 0.5% in retirement would be inside of a traditional retirement account. So again, when we're talking about fees, let's truly talk about fees and understand what we're paying elsewhere. But now I want to highlight something else. So we started this talking about, get over here. We started this talking about front-loaded fees versus compounding fees, meaning traditional retirement accounts have a compounding fee structure. But there are different types of life insurance-based product. And that those different types of life insurance-based products have different types of front-loaded fees. Have you ever calculated that front-loaded fee? Meaning, have you ever looked at what the initial expense of your policy might be? This is where if you have one, here's the opportunity to go get it. And I don't care what the type is, whole life, term policy, doesn't matter. Here's an opportunity for you to do a very simple calculation to understand how these two fees function. And to make it, to kind of give the answer to the test, a a compounding fee is really about low fees to start with a short-term gain. Whereas the high front-loaded fee, meaning the fees at the start are higher, but there's more of a long-term gain, meaning the fees getting smaller over time allows you to generate and build more cash value over time. And it's the same way whether we're talking about a leveraged IUL or a whole life policy. Doesn't matter. The goal is, again, what is the goal? The goal is income. The goal is cash value. The goal is leverage. And so what ends up happening is even though the fees may be higher to start, because if it's structured properly, those fees reduce over time, which allows you to have more long-term gain in the future to be able to have access to your cash value. And so wanted to jump into how we evaluate the front-loaded fee structure. And this is a very simple equation. And I'll make this a little bit bigger for you. The equation for evaluating what that initial percent of expense is inside of your policy is very simple. You take the premium that you're contributing, you subtract that from the first year's net cash value, and you divide that total amount by that initial premium. So again, it's the dollar amount you're contributing minus the net cash value at the end of that year, divided by the annual premium. And that gives you what that front load fee percentage is actually going to be, or what it looks like over time. And the differences between I'll call it whole life and an IUL or a leveraged IUL or just a properly designed IUL usually is this. You're looking at a difference of somewhere between 25 to 40% inside of most, again, just based off the time that I've spent going through clients' policies, I'm seeing anywhere between 25 to 40% is that initial fee compared to about 10% inside of a properly designed IUL. And just to be fair, whether we're talking about whole life or an IUL, whether we're talking about whole life, an IUL, or even a VUL, or even a UL. It doesn't matter. They all can be designed poorly, which would impact your ability to be able to generate the cash value you need by that front-loaded fee being so high. So the key is, again, goes back to structure. Is it max funded? Are we purchasing the least amount of life insurance legally possible? Is it option B? Is that death benefit increasing? Are we using a vehicle that can guarantee that I can't lose? And do I have the ability to put leverage inside of this product? So what I wanted to do here is just calculate that front-loaded fee in a couple of policies. And this is just a partial of a whole life policy that actually a live policy from a client that I was evaluating over these last few weeks. And this is the same $6,000 in annual premium. And I cut it out because we didn't need all of it. But the bottom line is we're putting in $6,000 in annual premium. And if you come over here, and what is that net cash value or accumulation value, depending on the type of policy that you have? What is that net cash value at year one? So if we just simply did the math around, okay, what is 6,000 minus that 4388 and divide that by 6,000? What does that equal to? And that is going to be whatever that initial percentage would be. And so, sweetheart, if you wouldn't mind jumping over to the calculator, again, this is something that you can do on your own. You don't need me to do it. But if your initial premium is $6,000 and the net cash value in year one is $43.88, and you divide that by the amount that you put in year one, the initial cash value, the initial premium, it equates to about, if I multiply this by 100, so it's about 26. I know it's kind of small for you to see, but it's about 26%, 27%. Bottom line is, like I mentioned, somewhere between 25 and 40% is what I've been seeing consistently. And again, just to do it again, just so that you see how easy it is. 6,
Yeah, say it slower for the people in the back.
Not a problem. 6,000, which is the initial premium that you're putting into your policy. What is the net cash value at the end of that first year? And again, it's sitting in your illustration. I'm pulling it right from the illustration. In this case, it's $43.88. What does that equate to? Okay, $16.12. We want to divide this number by that premium that you're putting in. The premium is $6,000 a year. What does that equate to? It equates to about 20. So what that's saying is there's approximately 26% of the dollar amount that you've contributed that's being eaten up by fees just in year one. 26%. Where did it go? You should have a fees page that breaks down where that 26% of your premium went. If you don't, you should be asking the question why. Or you should be jumping on my calendar so we can dig into some of the reasons why that might be and what you can do about it. So, sweetheart, if you jump over to the other side again. So, what does that same process look like inside of again, a properly designed IUL? And in this case, and I'll drill in a little bit more, it's the same $6,000. And if you come over here to the non-guaranteed section, the accumulation value is $54.55. So again, zoom all the way out so you can see it all in one shot. It's the same $6,000, but notice the accumulation value is $54.55. So I hate to do this to you, sweetheart, but let's jump back over to the calculator and let's do that math.
I got you.
So what does it look like if we are just simply contributing the same $6,000? $6,000, and you subtract that $54.55 is the accumulated cash value. The accumulated value at the end of year one, $54.55. What does that look like? And if you divide that by the same $6,000 that we're contributing, it equates to, let's multiply that by 100.
You put 60,000.
Did I? Let's do it over.
Let's do it over.
6,000
One more again.
minus 5455. What does that equal? And divide that by 6,000, not 60. My bad. 6,000. What does that equate to? And again, just so that you can see the percentage, I'm going to multiply by 100 so we can get the actual percentage. It's about 9%. What I've consistently seen is somewhere around 10% or less if the policy is designed correctly. If I was to pull up my own policy is about somewhere around 4%. So consistently, and because these strategies are all designed the same, when you are getting a properly designed cash value life insurance policy with leverage, they are all structured and designed the same. It's not unique. The goal is to make sure you're paying the least amount in fees up front so that you can build the maximum amount of cash value. It has to be structured that way. There is no other option. So, moral of the story is you can do this too. And there's several other policies that we're going to be going over tonight, or at least skimming through, because I'm not going to spend a whole lot of time on these policies. But again, the simple math around what are those front-loaded fees I'm experiencing is by taking the premium that you're putting in, the cash value minus the cash value at the end of that year, and divide that by the premium that you're putting in, and it gives you what that front-loaded or upfront expense is inside your policy. So when you have someone with who's designing this whole life policy and they give you a 60-40 or 40-60 policy, what are they saying? They're saying that at the end of year one, that $100,000 you put in, you will have access to 60% of it. Which means if we were to just use their math, if it's a 60-40 policy, meaning I've got 60% of my cash value at the start of year one, where did that other 40% go? It's an expense that you don't have access to. It's an expense that is not coming back to your policy. Yeah, you got 60% of your liquidity up front in 45 days, which is awesome. But where did the other 40 go? And how does that impact your ability to actually build and generate cash value over time? Versus in most properly designed cash value life insurance products that I've seen that are done correctly, the max liquidity I've seen in year one is probably somewhere around 30 to 50%, which is not that good. But the accumulation value, the how much money is actually working for you, again, is somewhere around 90+%. That dollar amount working for you is how you build cash value over time. So that's what you want. All right, I think I beat that dead horse. So if you jump back over to the other side, sweetheart, and again, I'm moving really fast. I know it. But now I want to jump from, okay, that's how you calculate the break even. I'm sorry, that's how you calculate the initial expense inside a policy. But what's next? Any of you guys who have talked to me about life insurance at all? No, my first question is always, when do you break even? And what you've got here is the answer to the test. So there's a few different examples that I pulled up. I've got 2 whole life policies and I got 2 IULs. And again, these are actual clients that are probably on this live tonight, if I'm not mistaken. And I've got 1 whole life policy that doesn't break even until I actually don't know when, because that says 15 years plus. I went through the entire policy and could not find its break even point. The next one I'm going to show is somewhere around 12 years. And then the last 2, they break even somewhere around either year 2 or year 3, but year 3 is I call it the consistent break even point. But wait a minute, why does this even matter? Why does it matter where you break even inside your policy? It all goes back to the goal. What's the purpose of getting it? The purpose of getting it is to build cash value. The purpose of building that cash value is so that you can do what? Leverage it, lend it out, join these communities, these real estate communities, and do syndications, buy self-storage facilities, buy properties, buy land. The goal is to be able to have this liquid cash so they can also grow externally, but also when I'm ready, when I need it, I'm looking for income. Well, how do you build income in any product? It's through compound interest. What does compound interest mean? It means your money is making money, and the money that your money makes more money. So the first step in building compound interest is your money needs to make money. If you put in $1 and it takes 12 years before your $12 just simply equals $12 in the product, then how long does it take for your money to just start making money? How about another 12 years? Do you have time for that? None of us do. So to understand where your break-even point is, to me, this is probably more critical than the fees. Because I can accept the fees if my break-even point is year 2 or year 3, because that means at least I'm going to start making money and outperforming that fee structure. So this break-even point is pretty important. So what I wanted to do was just highlight a few policies. Start here with this one. And as I mentioned, these are actual client policies that I am reviewing right now. And how do you identify where the break-even point is? Well, the first step is you have to add up what it is being contributed. And as you add up what's being contributed, you want to compare that against the net cash value. So I'm going to zoom out and draw a line, which won't be straight. So I apologize, sweetheart. But the bottom line is, in year one, this client is putting in $74,000. And the net cash value in year one is $55,387. So if we were to just simply, again, put in $74,000, the net cash value is $55,387. Say it again, put in $74,000, the net cash value is $55,000. What is that front-loaded fee percentage? I don't need the calculator, but I'm gonna do it real quick. 74,000, and you guys can do it with me. 74,000. I didn't know you didn't need to, but that's fine.
But
74,000 minus 55,387.
It's a field trip.
It is a field trip. 74,000 minus 55,387 equates to 18,613. If I divide that by the 74,000 that I put in, that equates to 25%. That means that up front, when you first put your first dollar amount in, you lost 25% to what? Where did it go? Because it's not coming back. Who did it go to is probably even a better question. So we already know we're starting from a deficit. So we've got 25% of our initial premium that we need to make up. So the question now is, where do we break even? Okay, sweetheart, go over to the other side. So now again, I'm not going to do this math. Let me get rid of this real quick. Uh-oh, there we go. There we go. As we contribute to this policy, it's 74,000 in year one, and it's 24,000 a year after that. And then by year 14, it switches from 24,000 a year to 21,955. Make it a little bit larger. Bottom line is, from age 53 to 67, which is 15 years, over this 15-year period, a total of $405,000 was contributed to this policy. Over the first 15 years, $405,000 was contributed to this policy. How much cash value is accessible or available at this same point in time? What is that net cash value over that same period of time? Here, let me make it bigger. How about 405,519? Let me go back. You have cash value of 405,519, but you've contributed 405,910. You have cash value of 405,519, but you've contributed 405,910. It's year 15, and you haven't even broken even in this policy yet.
You did.
No, you didn't.
You said 919.
405,519.
Yeah, 5. Okay.
405,519 compared to 405,910. You're still $400 short. And I get it. It's minor. But when you look at the perspective of, at what point can this individual start generating enough supplemental income to add to what he's doing in retirement? Well, if he was going to do this, if he was just going to use the money he's already contributed into this product, then why didn't he just take this dollar amount and put it elsewhere? Why didn't he just take this dollar amount and put it in an ETF? Why didn't he just take this dollar amount and invest in real estate? Because his money has made him nothing in 15 years.
Exactly.
How many of us have a policy doing the exact same? And notice, this is a bare bones policy. No action has been taken, meaning I haven't even mentioned the word infinite banking. I haven't even said, hey, what if in year 5, I borrowed $100,000 from my policy to go do this thing?
Well, it's year one. Most time, what's really being sold is the concept that their cash value is available for them within the first year.
That's it. And so what's the impact over time in this policy if you were to just simply do what somebody told you this policy was designed to do? What's the impact over time?
Right. Because if they don't break even until year 15, what happens when they have a loan inside of their cash value?
That's it. And so I wanted to look at another policy. This one is back to the $6,000. So it kind of dumbing the numbers down a little bit. The $6,000 a year being contributed in year one, there's $43.88 in account value. Again, 6,000 going in, $43.88. Guys want to do the math? 6,000, $43.88. Go jump over to the calculator. So you put in 6,000 and the cash value is $43.88. That equates to 1612. Divide that by 6,000. We're back at that 26%. So this policy we already know functions somewhere around 26%. Sweetheart, jump back over. So where does it break even? So again, if we were to just simply add up 6,000, we've contributed $43.88. Okay, 26% is gone in year one. I get it. But as we contribute that 6,000, in 10 years, we would have put in $60,000 into this product. $60,000 have gone into this product in 10 years. That cash value equates to $56,911. Put in 60, in 10 years, you got $56,911 in accumulated value, or an account value rather. So how much longer does it take? Well, year 11, that'd be 66, it's 65. Year 12, you put in 72, In year 12, you've got $74,000 in cash value. The break-even point inside this policy is 12 years. At least it's better than never. It's definitely better than 15. But is that sufficient? Is a 15-year break-even point sufficient enough for you? It can't be. If the goal, again, what's the goal? If the goal is income, if the goal is to be able to use your money to be able to live, is a break-even point of 12 sufficient for you? It's not. So what does it look like when we jump over to a properly designed IUL? And what do I mean by properly designed IUL? I'm talking about a max-funded option B IUL with leverage. What does that look like? And in this case, these dollar amounts are a little bit higher. This client, I believe she's 49. And she's putting in $68,000 in year one, $68,000 in year two, a $50,000 lump sum year one, $50,000 lump sum in year two, and then $1,500 a month from that point forward. So year one is $68,000, year two $68,000, and it's $18,000 from that point forward. So okay, how much accumulation value is there in year one? Put in $68,000, there's $65,431 available. So the accumulation value in year one, $65,431. Let's do some math. So, okay, if I put in $68,000 and I've got, you jumping over to the calculator, sweetheart. If I put in $68,000 and the accumulation value is $65,431, that equates to about $25.69. Divide that by the premium, which is $68,000. What does that equate to? Here, let me multiply this by 100 so you can see it a little bit easier. We're talking 3%. And this is a policy that, actually, I didn't build this policy. My son Justin built this policy. This is a policy that was built, I want to say, a week ago. So again, the expense up front is 3% of what they've contributed. And now the question is, where do you break even? So sweetheart, if you jump back over. So 68 plus 68, 68,000 plus 68,000 is what? 68,000 plus 68,000 is 136,000. So between year one and year two, you've put in 136,000. What is that accumulation value at year two? 134,000. So it's not year two. But then you add another 18 grand to that 68. So 68 plus 18. So if I add another 18 to that, that equates to 154,000. So in the first 3 years, there would have been 154,000 contributed into this policy. 68 year one, 68 year two, 18 in year three, that's 154,000. What is that accumulation value at year three? How about 157,000? The break-even point in this policy is year three. And this is no leverage. This is just a bare bones IUL. You can get it from anywhere. You can get this structure from anywhere.
Just out the box.
You can get it. I don't care what the company is. You can get a max funded option B IUL from any mass or any mutual life insurance company. So I won't say from anywhere.
Will it
any
break,
mutual life insurance.
Will it
company.
break even in year three?
Again, if it's max funded, If it's option B, if that IUL is designed with a decreasing fee structure, absolutely.
But how do you know what the fee is and how it would help you? Like, how does somebody know if
Yes.
their friend, let's just
Yes.
say their friend sells life insurance and they're
Yes.
wanting to support their friend,
Yes.
and their friend has no idea. Their friend does not tune into you.
Yes.
Their friend is a part of a life insurance MLM, which
Mhm.
do exist, by the way.
Mhm.
And they just are wanting to support them. So now that maybe they've already gone down the road, how do they know that their friend is designing them a policy that would perform or break even in year 3?
So it's understanding what is meant by the words max funded. How do you know if I'm purchasing the least amount of life insurance legally possible? I just had this conversation today. I have a client that I built a policy for. He was 29 when I built it. He's 31 now. He's 2 years into his policy, and his issue was, hey, that policy you built for me. Again, he was 29 then, he's 31 now. He's putting in $300 a month into his policy. That's $3,600. And he was concerned because his $3,600 a year is only buying $100,000 in life insurance. I built this policy for him. So it's a max funded policy. How does he know? Well, one, the amount of life insurance is low. And two, if you look at his MEC limit in this policy is $36,003. So the maximum he can put into this policy is $3,600. The least amount of life insurance he's buying is $100,000. He called me today and said, Donnell, I think I'm going to close this policy and start anew. I said, why? He goes, gentleman offered me an IUL that has a $500,000 life insurance amount. It has a $500,000 death benefit. The death benefit in my policy is only $100,000.
Yeah, why'd you do that, Donnell?
Right. I'm putting in this, and he said for the same dollar amount, I get more life insurance.
That sounds like a better deal.
Right. The maths.
Yeah.
I said, hey, let's get on a call. Because rather than me type all of these words, how about I show you the difference between a policy that you're putting in $3,600 a year in for $100,000 in life insurance compared to a policy you're putting in $3,600 a year for $500,000. How about we do a comparison? Because my first question to him was, why did you get this policy? And he gave me a whole list of reasons why he got the policy. None of them were because of life insurance. Meaning he didn't get this policy because he needed a larger death benefit.
Right.
Because if he needed a larger death benefit, why get a policy like this at all? Why not go get a term policy? If you wanted that same $3,600 can buy $1 million policy if we wanted it to. So what's the goal? The goal is income. The goal is leverage. The goal is to be able to fire his job. He was 29 when he got it. He's 31 now. It's the excitement around being able to have a vehicle along with my traditional retirement account. So if that's the goal, then let's understand how this works, how this product works to be able to achieve that goal. And then let's compare that to this other policy for the same dollar amount, but with a higher death benefit. What does max funded mean? Max funded means we're buying the least amount of life insurance legally possible. So if his policy for $3,600 is $100,000, but this gentleman is wanting to sell him a policy for $500,000, is that a max funded policy? It's not. What does that mean? We're buying more life insurance than maybe we need to. If we're buying more life insurance than we need to, who is that benefiting? Who benefits from you buying too much life insurance? Is it you? Now, I get it. God forbid you get hit by a bus, your family's taken care of. So you can, the boomerang back to me could be, yeah, I benefit because I have a much larger death benefit if something happens to me. But why did you get the policy though? You got the policy for income, right? What is that higher death benefit? What's the impact of that higher death benefit on your ability to generate cash value? Well, the more life insurance you buy, the more expense to you. The more expense to you, the less cash value accumulated. So when we do that calculation of what is that percent of initial fees, is it 3%? Is it 6%? Or is it 27, 28, 29%? Like who actually wins here? And when I peel back these layers, it was like, well, his question to me was, well, why didn't this guy explain that?
Aha. Aha.
The less you know, the more he makes. But that's why we do what we do. So to your question, I know it's a long way of getting there. So to your question around what do you do? Again, you have to understand the structure. Is it max funded? What does that mean? Is it option B? We haven't talked a whole lot about option B tonight. Is it option B is saying, as I contribute to this policy, does my death benefit continue to increase? Because this is what I also showed him. His issue was, gosh, if something happens to me, $500,000 sounds better than 100,000. But with an option B policy, as he's contributing to his $100,000 policy, I showed him where his death benefit is continuing to rise. And in about maybe it was 10 years of contributing to this policy, his death benefit had already hit $500,000. So he's still going to accomplish the same goal of being able to leave a legacy. But in addition to that, he's also building the maximum amount of cash value, which is what he needs. Hopefully that answered.
Yep. Nathan had the same question I
Yeah.
did, and it was, how does this change in the other, like the 12-year break-even
Yeah.
policy? How would that be different if they had a lump sum up front?
Yeah. The larger the lump sum, the larger the amount working for you in year one. But if it's poorly designed, that just means also the larger the commission of the guy who created it. So a poor design is a poor design, whether you're putting in $1 or $1 million. I think the key piece is making sure we're purchasing the least amount of life insurance legally possible, making sure we're not buying too much life insurance and reducing the fees inside of the product. I think that's the key piece, whether it's a lump sum or not. Because I think, correct me if I'm wrong, in the examples that I showed, I'm pretty confident I did this. The first one was when we were doing the calculation, the first one was a policy with a lump sum that broke even around 25%. The initial front loaded fee was 25%. Then the next one I did after that was $6,000 a year, no lump sum, and it was at 26%. So in that scenario, the policy with the lump sum had a percentage less in initial upfront fees than the one that didn't have a lump sum. So it kind of doesn't matter because it's really around this design. If it's designed wrong, it doesn't matter whether you're putting in a lump sum or not. That makes sense.
Yeah,
Great question, though.
He says, that's what I figured. It would be a longer time to break even because the fee would be even higher.
Exactly.
Yeah. He was saying the guy forgot the goal, which is what his favorite saying is from, our community is, what's the goal, and staying focused on that goal.
That's it.
And Brenda said, when you remember your goal, you won't be sold.
That's it. And I think that's the reason I wanted to get on a call as well versus typing that. I wanted to show him, you said this is what you were trying to accomplish. And so I think you're spot on with what's the goal.
Yeah.
So the only other thing I wanted to show here is, okay, what does this look like inside of a policy with the leverage? And again, kind of to highlight what we were talking about, they were putting in $50,000 year one plus an $18,000 a year premium, $1,500 a month in year one and in year two. But in year three on, we're going to just simply add leverage. And here is what that leverage would look like. We're adding $50,000 in year three. We're adding $50,000 year three, $50,000 year four, $50,000 year five, $50,000 year six, but then we're going to jump up to $68,000. It continues to jump up from there. So when we add the leverage, it changes that premium outlay over time. But what is the client responsible for? What is the individual with this policy responsible for? Well, in year one, they're responsible for the full 68. In year two, they're responsible for the full 68. I think I got it in here. Yeah, I do. But from year three on, they are still only responsible for that $18,000 a year. This leverage that's being added is being added from the life insurance company. This is being added in addition to your standard premium. So you are only responsible for the 18. So following this same strategy, where is the break-even point? Well, if I put in 68 year one, 68 year two, we'd already determined that the 68,000 year one, year two didn't break even in 3 years. But if I add even more, and again, that difference, that $50,000 difference between what I'm contributing and what the life insurance company is contributing, the 68,000 total, all that's going to do is add more cash value for me. So without even doing the math, obviously my break-even point is going to still be year three. I just have more cash value in addition.
But it also costs right? There's a cost associated with that
Oh yeah.
because everyone's going to say, "Oh, but he didn't mention that there was a cost."
Oh yeah. And I think I have it in here. Yep. So we are actually going to address that next. So thank you for getting ahead. But the bottom line is the whole point and purpose for me kind of going over this was understanding that break-even point and why it's important. And a poor design is a poor design. If the policy is designed correctly, you can get to a point where that break-even point, and I'd say I have seen whole life policies that break even at year 5. So it does exist. But it takes a lot of effort from the person that is creating it and the company that they're getting it from to be able to do so. So the last thing I wanted to hit is the famed surrender charge. And that is where we will dig into the fees of what a leverage policy would look like. But let's talk about the surrender charge. And this is where I mentioned earlier, there are 3 buckets of fees. There's the premium charge, the expense charge, and the cost of insurance. Those are the 3 buckets that impact your premium as you contribute. As policy what?
Impacts the performance on the policy.
Yeah, but those are the 3 fees that when you put in $1, those are the 3 items that come out of that dollar. The premium charge and the expense charge, I'm calling an actual expense. The cost of insurance, I'm calling a cost of doing business. But those are the 3 things that come out of that dollar when you put it into your policy. But there's also this surrender charge. And I have caught a fair amount of heat around the surrender charge because people say that I don't mention it enough. And it's really simple. It's because I don't see the surrender charge as an actual charge. I call it, what if? What if what? Well, what if you cancel your policy? This is the charge that would take effect. But if you don't cancel your policy, there will be no surrender charge. The surrender charge isn't $1 that has been removed from your policy, and I'm going to show you. But the surrender charge is the life insurance company saying, hey, look, we didn't charge you to apply for this policy. We didn't charge you to go through underwriting. We didn't charge you to get your exam done. We didn't charge you for the maintenance involved in your policy. In an IUL, there's call options. There's been no charges around any of those things. And you did say you wanted an asset. Okay, so from their perspective, they've taken risk. You are the risk. And the way they make sure their risk doesn't, or the way they make sure they're not taken advantage of, let me phrase it that way, is there is a fee that is held back from you being able to access to make sure you're going to be here over time. So again, what is a surrender charge? Surrender charge, oh, let me get rid of that. A surrender charge is an early cancellation penalty, and it allows for significant low front fees. Another way of looking at it is the surrender charge is the reason why the front load fee is so low. Meaning, instead of that dollar amount being charged to your policy and them taking it up front, like some of the other policies that we saw, the surrender charge is actually them saying, hey, we're going to hold this dollar amount because we know we'll recoup it over time as this policy continues to grow. But if you decide to jump out of this policy in year 1, there's a portion of your cash value, of the accumulation value that you have, that we are going to pull to pay for all of the things that we've done prior to you starting this policy. So it's a what if charge if you cancel. And again, the common misconception, and again, this is one that I have talked with a lot of agents who say, but what about surrender charge? And what they don't realize is it's not an actual charge. It's a dollar amount that's held back in case or if you cancel. And as a result, that allows us to charge the lowest fee structure possible and allow you to break even as early as possible. Because notice, if you're able to break even year 2, year 3, year 4, you're putting your money in a position where it can build the maximum amount of cash value. So the benefit is this fee structure, all of these things added together, all of these things combined is what allows us to provide you with the lowest fee structure possible. And ultimately what this is saying is this a product you're committed to or not? Because it goes back to, what's the goal? Is the goal income or not? because there's not a whole lot of income being generated in your 401k, your IRA, your 403b, your TSP, a whole life policy, a universal life, a home equity line of credit. There's not a whole lot of income or growth generated in year one in anything. So if the goal is income, if the goal is cash value, if the goal is growth, you do have to give your money time. And so if the goal is passive income or replacing your expenses or being able to retire early or just having control, if that is the goal, then it seems to me like, yes, you are committed. So if there's a commitment, it's just identifying what is that commitment factor. And based on that, again, this is not a fee. It's a what if. If you do this, that's what will occur. So let's look at it. And let's start with, I'm going to use that same policy that had the $50,000 lump sum year one, $50,000 year two, and then $1,500 a month or 18 grand a year going forward. Again, these are the fees. There's a premium charge, expense charge, the cost of insurance. This is that initial policy with no leverage. So we're going to look at it before the leverage, we're going to look at it after the leverage, and we're going to identify the differences between the fee structure. So, but we're focused here on the surrender charge. Notice, if you put in 68,000 year one, you do not have 68,000 available to you. You only have 65.4. All right. But what's actually available to you? Well, what's available to you is 26,629. So you put in 65, you put in 68. There was about 3% in fees. The difference is 65,431 is what's working for you in the policy. But what do you have access to? If you wanted to borrow against the policy and use it to buy real estate or buy land or become a hard money lender, how much do you have access to? Well, that's the surrender value. And in this case, it would be about 26,629. But what is the difference between these two numbers? Again, you have 65,431 working for you, but you only have access to the 26,629. What is the difference between those two numbers? Well, today's been about the calculator. So if you simply subtract 65,431 from that 26,629, you get 38,802, which happens to be the surrender charge. And again, if you take this number and subtract this number, you get this number. So the difference between what's working for you and what you can use is the surrender charge, which means it didn't go anywhere. It's still sitting right here. You just can't touch it yet. But as the years progress, what happens? This dollar amount gets smaller. As this dollar amount gets larger. As this dollar amount gets larger, meaning the surrender charge continues to get smaller. And at the end of 15 years, it's zero, which means they're just releasing more of these dollars back to you that you're able to access.
Or they should be if you're looking at your policy, correct?
Right. Well, in most cases, and I'm going to say 99.9% when we're talking about the surrender charge, any surrender charge in any policy or annuity functions in this fashion as it does reduce. Now, the expense charge and the premium charge, that could be different because that's where commissions are located. But in the surrender charge, it's designed for this. It's designed to allow the life insurance company to be able to recoup what it is they have spent if you were to cancel early. But again, they release a certain amount every year back to you that you can leverage. And by year 15, it's zero. Because notice how these numbers are now the same. So this is in a policy with no leverage. How does this look inside of a policy with leverage? And again, showing it again, we're putting in 68,000 year one, 68,000 year two, you're putting in 18,000, but we're adding leverage from this point forward. What happens to the expense or the premium charge, expense charge, and the cost of insurance during this time? Well, notice, initially when I was putting in 68,000 into this product, the premium charge was $23.74. 68,000, $23.74. 68,000, $23.74. That 18,000, it drops down to $810 because I am no longer contributing the 68. But if the life insurance company is now adding the leverage, which means now we're putting in 68,000 for the next, let's call it 6 years, notice the 2374 carries down. The premium charge is based off what? The premium charge is based off the premium. As long as I'm contributing this premium charge will be deducted. And as the premium charge goes up at year, what is that, year 7, the premium jumps up to 86,000. Notice the premium charge increases as well. But if I stop contributing at age 65, the premium charge goes away. The premium charge is specifically tied to what I'm contributing. The expense charge. Let's go over to the other side. The expense charge is $23.52 to start, $519 at year 6, and it's $60 a year forever. That's the expense charge. Well, what happens when I add the leverage? It's $23.52 to start. At year 6, it drops. It's let's see, is it $519? Yeah, it's the same. So it's the expense charge is so. And here's what the life insurance company is saying with the expense charge being the same. It's $519 at year 6, but then as you contribute more, as the more leverage is added, the expense charge is a percentage of what's being contributed. So the expense charge during that 10-year period, it fluctuates based off what's being contributed. But by year 11, what happens? It's $11 a year forever from that point forward. So the expense charge is still decreasing, even though as leverage is added, the expense charge increases based off that leverage, but at the year 11, it becomes $60 a year from that point forward, regardless of what is being contributed. And again, your policy has to be designed correctly. The expense charge has to be a decreasing fashion in order for you to be able to accumulate the dollar amount necessary. How about the cost of insurance? The cost of insurance is based off your age, your rating, and what's being contributed. The cost of insurance is directly tied to what's being contributed based off your age and your health. So if you're contributing more, what happens to that cost of insurance? It absolutely increases. But here's the key to all of this. Is the growth in your policy able to outpace the fees? Because notice, your responsibility in these contributions is $18,000 a year, which means these fees from year 3 on are actually being paid for by who? They're actually being paid for by the leverage dollar amount. So all of your money is going to work for you. It's the leverage dollar amount that's actually paying these fees. And then the last piece is the surrender charge. The surrender charge still decreases as it should till year 15. But what was it? What was it in the original policy? Went from 38 to 36 to 32 to 29 to 27, 38 to 36 to 27. All right. How about it's the same surrender charge? Why during this period we're putting in the same dollar amount, $68,000 a year?
Okay,
But as
I have a
Go ahead.
question. I have a question.
I want
Well,
to move yourself to the other side.
yeah, here we go. Okay.
Mhm.
I have a question. If why is it that the majority of people who belong to the Church of Whole Life Insurance Policies, just going to call it that, why is it that they constantly are attacking the surrender fee as their biggest, like, we removed the curtain and exposed the wizard because look at the surrender fees? Can you break down why they that is their
Go to?
yeah, why is that the thing?
Well, as you know, I didn't grow up in this space. So I don't consider myself a life insurance guy. And the truth around life insurance in general is I'm going to say majority of policies are poorly designed. Because in order for you to have a properly structured cash value life insurance product, you have to have a life insurance company that's going to design it with the right fee structure. You have to have an agent that understands how to structure it. And that structure has to be solid.
Nathan's going to take my point.
This is a commission-based business. In most cases, you're dealing with people who are focused on making sure they can make the highest commission. And so the argument is in a policy that is poorly designed, if these numbers are wrong, if these numbers are increasing, this policy will eat itself. IULs have a history of eating themselves, meaning because the fee structure is so large.
Oh, wait,
that,
hold on. I gotta bring it back up then so that they can see what you're circling.
Yep.
Stand by. Here we go.
In most cases, in most policies, this design, this fee structure, if this was not designed as a decreasing fee structure, imagine this expense charge compounding, meaning it was $23.52 in year 1, but it doubled in year 2, tripled in year 3. What ends up happening is this fee structure, if designed improperly, can eat up your cash value. And once it eats up your cash value, your policy implodes. So I don't know that the people who dislike IULs don't actually have an argument. Meaning, there are some poorly designed products out there. And you can put yourself in a position to where, yeah, it benefits you, the agent, but it does not benefit the individual who has it. So the reason they harp on the cost of insurance and the surrender charge is because they're right. Like, you have to intentionally design these products properly. So the surrender charge is think about it. Let's say I'm at year 8 and I learn at year 8 my cash value is next to nothing because the fees inside my policy has eaten up all of my cash value. What's the first thing I'm going to do? I'm going to cancel this policy.
Right.
Because I have nothing. I've put in 10 years or 8 years of premium and I have nothing to show for it. I'm going to cancel this policy only to learn before I cancel, the life insurance company is going to need 49 grand. So if I'm out here selling a product that doesn't have a surrender charge, that is absolutely my argument. You don't want a product like this. Why? Because you're handcuffed. So I actually agree, but it goes back to the structure. If this policy is structured correctly, I think I got it right here. If this policy is structured correctly, none of that matters. If this policy is structured correctly, it is impossible or next to impossible for this policy to eat itself. And I don't care how many consecutive down markets we've had. Like, there's all sorts of arguments that I'm happy to make because it's around the structure. I don't know that I answered your question.
It's why is this the thing that they harp on? And hold on, I'm gonna come back in for 2 seconds. Right. Yeah, we gotta figure this out at a different time. Here's the point that I was trying to make earlier. I was trying to say that I think Nathan said it best earlier. He kind of took the words out. It was the restocking fee. If you have a product that is returned pretty frequently, if you have a product that fails and people have to buy another one, if you have a product that, like Veronica here in the chat, she was saying, we've seen this 1,000 times. My mom cashed in her policy because it would cost her more to put in than what it was worth,
Right.
because she is at 83 now.
Right.
And a lot of people, they have put more in their policy than the death benefit, even.
The break-even point. Absolutely.
Well, even the death benefit, even if they thought that they were going to get cash value, and a lot of whole life people don't realize until far down the road that when they pass away, they don't get to take the cash value with them.
Yeah.
And so they're afraid to use it because they understand how it could implode their policy and they could lose everything. So then they don't end up using it, or they end up using it frugally, thinking that they would be leaving it to. Understanding how you're structured matters more now than ever, especially since there have been some realizations along. I'm just going to say insurance companies being able to make their own rules too. That it matters. Here's the point. Here's my rant. Can I go on my rant?
Let her cook.
Here's the point. It doesn't matter though. Let's say the surrender fee was 100% of all the money that you put in there.
Charge is not a fee. Keep going.
Surrender charge. What if the surrender Dorothy? Okay, let me get off. What if it's 100%? Here's my point. When we sign up for a 30-year mortgage,
Oh man.
we have the majority of our payment goes to
To the bank.
interest,
Mhm.
goes to interest, and a fraction of it goes to principal. To where 5 years down the road, we absolutely are still not even. We are still in a position where we're paying more interest than principal, right?
Very true.
And for how long have people just gone, yeah, that makes sense.
Right.
No, I'll sign up for that.
Right.
Please, I would love to do that. The majority of Americans move within the first 5 years. The majority of Americans end up refinancing within 5 years, which means they start that clock all the way back over again. So they're never actually making headway on the principal.
Paying that surrender charge.
This is why we were able to pay our house off in 4 years. We couldn't even figure out how long it took us because it's been paid off so long and we've reused it.
Still
So
think about it.
yeah, that once we figured out that it was around that 4-year mark actually, and then we just started using it for other stuff. The point here is the majority of people would go, yeah, no, I'm signing up for that because it's like normal. It's normal. Everybody understands it. They feel okay with it. Emotionally, we feel okay with a 30-year mortgage and paying the buy two, get one program for a home, right? Buy two houses, you give the bank enough money to buy another house, and then you get to keep one. Maybe, because guess what happens if you stop making the payments? Do you have cash value inside of your home? Do you? Do they say, hey, you know what? If you want to walk away from this and you just don't want to pay anymore, then you can have what you've put in the house. Do they do that? Where do they do that? Please call us and we'll put you on the air right now. It's not a thing. Matter of fact, you lose everything that you've put in if you don't structure yourself correctly, right? And this isn't even talking about the difference between a 30-year and a HELOC, 30-year and adding a second lien HELOC, 30-year and
But you're spot on. You're talking about assets. This is an asset.
right.
Show me the asset that you can purchase and not have and have the same opportunity. So you're absolutely correct, because that asset that we're purchasing as a home, we're impacted by the same thing and we accept it.
Right.
No different than the 401k. We want to talk about fees, but we are contributing to our company's retirement account gleefully, not realizing that we're losing 2/3.
Right.
And we do it gleefully.
Not only
in condition to accept it.
not only are we losing money by participating in some of these vehicles, we're paying somebody else's salary in the process. We're giving them tax breaks that we do not get ourselves. Yes, you get a tax break today. It's not a tax break. It's a tax deferral.
Right.
So it's it's the same thing. And what if you had to front load all of your taxes for life? And so for like the first 10 years of working, you had to pay 90% of your income, working income, to the taxes that you would eventually owe. You have no idea.
Be careful, that might be coming.
But that is the program.
Don't say that.
And you had no way of opting in or out of it. You just had to do it.
Right.
Essentially, that is what we're doing. The point that I'm trying to make here, and that I hope is sitting with people, is it's not about the fees. It's not about the vehicle. It's not about the terms necessarily. You strip all of that away. Strip all of that away, and you're just looking at the strategy. You're understanding how the math fits together, not picking one thing based off of a number and picking another thing based off of a number or an opinion, and then picking another thing based off of a number, but you understand how these things fit together for a strategy to help you reach your goal. This is the biggest difference that for me, this is where it clicked for me. It's the commitment. It's the long-term piece of this. It's if you can't do the math all the way through to see how this would impact you, then you're trying to do fix and flip on these vehicles, right? And it doesn't work like that.
Right.
But speaking of fix and flips, there would be no flipper, real estate investor who would be okay with purchasing a property and then not making money on that property. You don't get your money back out of this property for 15 years. Not going to happen. That is a bad deal. There is nobody else who is signing up for passive income, the idea of passive income, the idea of becoming your own bank, and says, you know what, though? I'm going to put my money here so that I can do that. And I can't even make as much as I've put in for 10 years, 8 years, 5 years. What's the number? What is the number that you need for that to make sense?
Right.
The problem that I have with this is that, again, the naturalization, I think is what it's called, is hyper-normalization. That's it. Hyper-normalization. There's a book, somebody wrote a book in 2016 on this topic, that back in the 80s, they understood that we had a problem. They knew that this is where we were headed. They understood that we were going to get to a place where these vehicles and systems were not working for people, and there was no way to fix what had been broken. But if they said it, if they showed everybody, it would cause so much panic and it would force them to come up with new systems and solutions. And that was just too hard. They didn't want to. These programs benefited certain people and systems to the point where it was not worth it, because the only people that were not benefiting from them were the ones who were feeding it. And as long as they continue to believe that these were, this is what you had to do, this is what the responsible thing to do was, they will continue to feed it. Now, this comes down to belief, and I'm using the word belief on purpose, because sometimes belief in having faith, right, is not being able to see something, and you're having faith in that strategy. You're having faith in the commitment to that belief. Actually, the people who are preaching, selling these same systems also believe. This is why you can't go to the HR lady at your work and say, why did you have me sign these 401k forms, and blame it on her? Blink, blink. Like, does that make sense? Because she doesn't know. They don't know. He, she, they, whatever, don't know what it is that they're having you sign. They've probably never read all of the paperwork. It is just a job for them. And for a lot of people in a lot of these industries, it's just the same thing. Gabo said it earlier, like, we're in the wrong business. We need to be doing financial advising and selling bad life insurance policies because it pays so well. So why wouldn't it make sense then? If this is the only thing that somebody does, why are they here? Is it because they use this for their own machine that they've built? Have they built financial freedom with these machines? Is this their job?
And that's my issue, because I don't want to spend a lot of time here, but that's my issue with the Dave Ramsey community. I really do appreciate the discipline that Dave Ramsey, I'll call it, preaches,
Mm-hmm.
because I think a lot of us need that discipline. My issue is, how does he maintain his livelihood if the people who he's providing this discipline to are so disciplined that they don't need him?
Yeah. Okay.
And so the issue is, what if there was a system where once you receive the discipline, then it was time to graduate to the next step in this process to actually be able to generate wealth so that you don't need the system? Meaning it's almost like a feeding school. You go through Dave Ramsey to get the discipline.
Yeah.
Once you have the discipline, now you come over here to self-directed retirement plans to gain control so that you don't need this system anymore. That's a infinite feeding system. But rather than do that, I want to keep the babies in the baby steps.
Yeah.
And that's my issue with.
Oh,
Go ahead.
It's not I want to keep. I don't think he really wants to keep people in the baby steps. I think what he believes about people
That's fair.
is that they're not
That's smart enough.
capable of
They're not smart
moving
enough.
forward.
That's fair. They
Yeah.
are sheep.
Yeah.
I believe.
Well,
Yeah, that's fair.
he
That's fair.
just believes, regardless of if you learn my entire program, you are still so stupid you could not possibly be in the advanced class. And if you can, then you better pay this huge fee and be able to pay for this fee in order to gain access to this information to move beyond and actually build some wealth.
Right.
I do believe that he throws out some nuggets that are of truth to people.
Again, the
That
discipline.
you
I'm
just
telling you.
you have to be able to decode it, to be able to put it into a strategy that actually works and not have it just sound like beans and rice.
Absolutely.
Right.
Absolutely.
And downsizing to a tent.
You absorb the pieces that you need to absorb, but when it's time to graduate, you graduate.
Yeah. Well, I mean, that's what I appreciate about what we can do. Not everybody can not give advice away for free and be on YouTube and just spend the time
It's
talking
not
to,
advice.
huh?
It's not advice.
Yeah, exactly. Run that banner. Hold on.
Where's Sequia?
Yeah, well, here we are. Okay. Not everybody can be on YouTube talking about this stuff, talking about their own personal journey,
That's the part.
doing it for free, right? Not selling information in that way and not trying to monetize or gatekeep and make it exclusive to those who can pay. Be the change you wish to see. So for us, it was once we realized that we could retire, we could completely, well, we did pretty much from what we were doing previously, right? We're done with that. So now this is what we do. Does it feel like retirement? No, it doesn't, because we're working pretty hard to help people. What we get to do though now, what we get to do is change lives on an exponential level. How you can help us help other people is by sharing it.
Right.
Not just saying, "Hey, go check out their YouTube channel." That's one way, and that helps. It's also by you studying it so that you can help each one teach one. Nathan's a great example of that. He could probably answer the majority of questions just like Donnell.
All of them.
Yeah. And Veronica too. She's getting really
Oh
good.
no, and I hadn't seen it because it's been a while since I've seen Veronica. Hey,
Yeah,
Veronica.
she came in later after you'd already
Yeah.
gone over there.
Yeah.
Oh, and Sherry's in here. Sherry, she just spoke with you. She's saying thank you for opening her eyes last week. But it's really, that's what it is. It's sharing it with more people, learning this stuff so that you can also share. Why? Because this should become dinner conversation, as we were talking about earlier. This should become, hey girl, let's go have coffee and talk about some new tips on the strategies that we're using to level up. Girl, can you believe that I just got 200 months ahead on my mortgage in 8 months? Like, could we start celebrating those things together, right?
Let's hyper normalize that.
Let's hyper normalize celebrating these types of wins. And when you are around people in your circle starts to speak the same language and you're all moving upward, you have a lot to celebrate. It's kind of sad actually when you do start on this journey like this. And I'm sure many people who are watching have felt the same thing. You start on a journey like this and you realize you can no longer have conversations with the same people because you're moving in a different direction and you're achieving things at a rate that they won't come. They just won't come. And it starts to feel kind of lonely. And having a place where you can celebrate with people because they get it and they understand it and they're willing to just hand you over the keys to the next leg of your race just because they know that someone's going to hand them a key and that's how we function. That's the type of community that we have been eager to build and we've been trying to build, and so far so good. Everybody in our community is pretty dope, pretty resourceful. But each one teach one. Help us spread the word and share it out. Starting by learning first.
So are there any questions? Because I'm actually done. I think the only other thing that I wanted to share was just the ending on the Skia piece. And because I talked a lot about a leveraged IUL, but just making sure those who came late know exactly what I mean as it relates to it. So that was the only piece. But other than that, I think we're done.
Oh, and
Yeah, that's fine. So you can just put me on full. And if there's any questions, we can jump to the questions.
Okay, hold on one second. I think.
There we go.
Oh, I'm trying over here. You know, I've got the.
I'm sorry.
Okay. We have one question from Lolo, or you can come over here too.
Either way.
Lolo says, and hi Lolo, by the way.
Yeah.
Gosh, it's been a minute.
Regulars.
She says, I want to contribute extra money to my policy before year 1 is up. You had given us a formula to use to calculate the max extra contributions.
Yep.
Can you go over that formula?
Okay. So let me make up a story. Let's say you're putting in $1,000 a month, which is $12,000 a year. Your policy should have been built max funded, which means that $12,000 a year that $12,000 a year means your maximum amount that you can contribute into this policy is probably like 12,005 cents. So again, your MEC limit and what you can contribute is the same. However, there's this little thing called Tamara 7, which means if there's an additional amount that you wanted to get in, some portion of that can be contributed. And let me give you, again, I'm just making up a story, but if you're putting in $12,000 a year, your MEC limit is 12,003 cents, your Tamara 7 might be, let's call it 18 grand, which means there would be room for an additional $6,000 if you wanted to contribute so. Now, if you wanted to put in something more than that, my suggestion would be we just wait till the start of the following year and do it at the start of the following year. But there is some room in your policy. I just have to pull up your policy specifically if that's something that you want. Do me a favor and just text me asking the same thing, and I will gladly share with you what your Tamara 7 is. And then once you say, yes, this is something that I want to do, I'll get you the payment instructions on how you can contribute that additional dollar amount into your policy before the end of year 1. So happy to help with that.
Gosh, I'm missing all these comments. There's like a whole conversation going on in here and I've totally missed it.
Good.
Okay, Gabo says, oh, come on the IUL designs you showed us, I noticed that there was no term writer fees. Is there not a term blend on your designs to be able to add more premium, or are these a pure base designs?
Yep. So the cost of insurance, that the whole cost of insurance structure is an annual term rider that increases every year as you get older. So the cost of insurance is the term rider fee. Great question. And it sounds like someone's been doing some deep diving, because that's not a normal question. That's a really good question.
Yeah, it does sound
really,
like
really good question.
somebody's learning.
Yeah, somebody's been
Yeah.
doing some homework. I like that.
I like
well
that too.
played there, sir. And it might even been a softball, because that's something I've never stated. I've never even thought to even bring that up. So thank you for that.
Yeah, but
Well played.
I mean, that is a rabbit hole in itself because of how some people say, oh no, my policies do that too, but they add the riders, which then increases the expense, right?
So riders is a matter of fact, that was a part of this discussion as well that I had with the 29-year-old who 31-year-old who got his policy when he's 29, and he's putting in $300 a month, and he was thinking of canceling this policy and starting a new one where the death benefit was going to be $500 a month. Oh, the death benefit was going to be $500. One of the questions that he asked was, but what about riders? He goes, does it have that terminal and chronic illness rider? Because that's important. And I was thinking about adding it to this policy over here, and I just want to make sure that that's something that's even offered. Not realizing that there are certain riders that are I'll call it complementary in this product. It is the terminal chronic illness rider, so that's 2, the terminal illness rider, chronic illness rider, the no lapse guard, which says, hey, God forbid if you needed to stop making payments, you have 90 days to pause those payments, and the automatic refund option. The automatic refund option is one that you will never use, but it's a great option to have because of the impact of poorly designed products. If you ended up with a policy that was designed incorrectly, there are certain points in your in the performance years of this policy that you can get everything that you've put in it back. So that's a great thing to have. But my point is this: if you have the terminal chronic illness rider, Do you need a long-term care rider? Do you need some of these other riders that a lot of times they are just added expenses? Again, what's the goal? If the goal is income and the goal is growth, we want to make sure we strip this down to the bare necessities so that your money is doing exactly what it needs to do to grow. And because the death benefit is increasing as well, you will also have those other features. But a given or the complementary riders that are part of this is the terminal chronic illness rider. So that matters. So you're right. That's a whole nother rabbit hole.
Rapid Rhymer is in
Rapid
the
Rhymer, like
chat.
the name.
Yeah, it's a cool name. He said, thanks for recommending that horrible documentary, The Retirement Gamble. Everyone should watch that horrible documentary because
Man,
it's a nightmare.
it is an absolute
Yeah,
nightmare.
watch it with a friend because it's scary.
My cousin posted a snippet from the documentary on her Facebook page. And I think you and I, sweetheart, are the only ones that commented on it. To me, those are the exact types of things that should be going viral around here.
Yeah, right.
As scary as that document, like that should be the one that won the Oscar, right?
Yeah.
As scary as it is, it's an absolute fact. And that documentary is super old, but it absolutely applies right now, especially with what we're headed into with these tariffs and whatever else you want to call it. We are headed into a path where if you were dependent upon your company's retirement account to be able to think that you were going to retire this year,
It's frightening for the majority of people to learn at this moment. That's the part that angers me, is you're learning at this moment. But this is with all of these different types of products. It's with your mortgage. It's with tons of major commitments that are a part of your lifetime goal, right?
right?
He says the 1% fee of a modest 5% investment vehicle is actually 20% of 5. Next time someone offers me 1%, I'll counter offer. To think of that a 1% or 2% fee could equal to be 2/3 of the total amount that you have contributed. What does that actually mean? 2/3 means you could have retired 20 years before the traditional retirement age if fees weren't taken out of your account. Fees. Now, if you go into our shorts, we have a whole bunch where I'm trolling with the editing, totally making fun of these big bank CEOs who are just on there lying and trying to sidestep all of this information. But that documentary right there, the way he holds them accountable and he is exposing them to the point where they're acting like, oh, we didn't know. We didn't know we were doing that to people. I said, why don't you educate people on why you're doing this, or the fact that you do this? Why don't you just tell people? They said they don't even read the instruction manuals or the terms of service that they agree to. All kinds of, they don't want to read that. They don't want to read.
They're not smart enough.
They're not smart enough. Yeah, they wouldn't understand it, and it would just make it all way too complicated. We wouldn't sell half of the stuff we do if people had to understand what they were buying. And I think my favorite quote from that is the lady who said the 401k is the most expensive product, and it's the only product that people buy that they have no idea what the cost is.
Now, that's where the control part comes into play. Because is the 401k the problem, or is it who the 401k is with, or the company that sponsors it? Are they the problem? Meaning, notice during the retirement gamble, we were talking to custodians, banks. Yeah. Is it possible that that same retirement account, you can strip those fees from those same retirement accounts and put them in a different position so that you're not impacted by them? And the answer is yes. So it's not the 401k that's the problem. It's not the 403b that's the problem. It's the fees associated, or the fees that the custodian, the bank that holds it, and the company that you work for, they actually work together to give you this product. And you know who benefits the most from this 401k with this match that you have? It's not you. It's the company you work for and their tax break. And it's the partnership with the bank that they have managing it and their fee structure. So what if we could eliminate those? And that's where the self-directed piece comes into play. What if you could have more control over those vehicles? If you had more control, could you beat the famed safe withdrawal rate of 4%? Absolutely you can. But so what's required? What's required is the education part. It's the understanding. It's knowing here's where I am, here's the goal, here's the gap, and here are the steps that I need to take to close that gap.
And who am I surrounding myself with who will have access to information so that I don't have to know everything?
Right.
Because I've got to know. I don't know what I don't know, and I can't know everything all the time. This is a perfect example. Gabo is in the chat following up with another conversation they're probably having here in the chat saying, hey, is your all-in-one going to be with CMG? Right? Is this the route you're going to go? Like, give me the tea. What's going on? Give me an update. He's like, no, I found a different thing. Finance group that caters to real estate investors, Ridgeway Lending. Hey, hold on a second. They said Ridgeway also has a calculator on their website that you can run simulations on. Options. I'm just looking at this conversation. If you're not in the chat, you're not asking questions for people who are actively
Sounds like I am missing some fun.
actively putting these strategies into play, and they are out there looking for what options are out there. If you're not paying attention, there's a ton of people who are flooding the market with options that are designed for velocity banking. They're designed for people who want to work smarter, not harder. They get it now. They have to become more competitive. They are losing trust with people because more people like us are out here exposing them. And we know now that we have options. We can become our own bank. So at some point, why would we need them if we could just become our own bank? They have to offer us options that are more attractive. They've got to start now building that trust and continuing to level up on those options, or who's the only people that are going to be able to use them are the people who are in debt to them,
Right.
the people who don't know how to help them, right? And those are those are not the best options for them. So Rapid Rhymer says, but of course, the only retirement route I'll be taking is the participating dividend paying mutual option B. Maybe. Again, would you like to fill in
It's about the math.
more information? Yeah.
So no, I think I heard it.
Okay.
So it's the dividend paying. So it sounds like if I heard it correctly, a whole life option B. I'm assuming it's max funded. My only question is, what the normal questions: break even, initial percentage of fees. Can you add leverage to it? To me, these are and conversations, not or conversations. It's not I'm only doing this. It's where is your leverage located? Our 9 times out of 10, our home is our largest asset we will ever have at our fingertips. Are you leveraging your home to be able to put you in a position to retire?
Yeah.
Are you leveraging your previous employer plans to be able to put yourself in a position to retire? Are you leveraging cash value life insurance policies? And I don't care whether it's whole life or IULs. I care about the structure. I care about the math. And so are you leveraging those? And again, these are and conversations. Let's be clear. And sweetheart, I think you remember this. We still have a whole life policy.
Yeah.
We still use it.
Right.
But here's what I know about it. I know it will never do what I need it to do as it relates to supplemental income. So if I'm
Right.
going to leverage and use it, I'm going to leverage, use it, put it back to its original form. I am not leveraging my whole life policy to be and expecting it to be able to produce supplemental income. It's not. It will never be able to do that. But you know which one will? It's that properly structured IUL with leverage. Why? Because it's designed to do exactly that. And this isn't an or. I'm not doing only this no, I'm doing it all. All of these products work together. All of these products function as one to be able to help us hit our goal. And so, and how about this? The items that we share isn't what even we're suggesting you do. We're sharing with you what we actually do. There are pieces to this puzzle that we don't even know about. There are some things around trust that I am so excited to learn. There are some things around how you leverage and use debt and you become a debtor for life. I am so excited to learn. There are so many aspects of this financial system and pieces to this puzzle that exist that we are not experts at, or are we even participating in, that I'm excited to learn because these are and conversations. Of course we don't.
I'm just grateful that we can share them with other people. That's the biggest part for me. Even if it's just to say, I get it's not an exciting Netflix thriller, but go watch it. The retirement gamble. Lolo says here, unfortunately, I should have starred in that documentary, but now I know, thanks to you two. And now at least you have the choice to choose to do something different now.
Right.
But that's the part, is that what they're talking about is that hyper normalization of, we already knew that the problem was bad. We're not going to say that because we've all benefited far too much from everybody else believing and continuing down that road.
Right.
We knew the wizard wasn't real. We all knew that the wizard wasn't real, and we just kept telling Dorothy and everybody else to just go down the road, and everybody thought she was so lucky because she was going to get to see the wizard, right? And she had on the ruby slippers, and that must mean something. And then you learn that Glenda was like, oh, she could have went home anytime. Anytime she could have just clicked her heels and thought to herself, I just want to go home. She didn't need my help. She didn't even need the wizard's help this whole time. And the scarecrow's like, why didn't you tell her that before? Because of hypernormalization.
But that can also, like, once you know it, it can also be empowering, meaning there is no one coming to save us.
Right.
Which means we have to look at this a little bit differently. It is not just a 40-hour-a-week job. It's leverage. I get it. You might not like it. I get it that when you come home, you're worn out and you're tired, but that is the start of your leverage. Are you leveraging your 40-hour-a-week job properly so that you can do other things? Or am I just working to eat, working to live? No, it's leverage. How do you use it? This home that you're in, are you leveraging it? Or are you just replacing the countertops and doing the bathrooms and buying the stuff and the things, and it looks nice, but you're really not leveraging it and using it as a vehicle such that it doesn't matter where you are. Everywhere is a party because I'm leveraging my home to be able to access all of it.
Right.
Like, where is your leverage? And are you putting that leverage to work? And if the answer is no, I think that's the part, because no one is coming. Matter of fact, they would prefer you not know. So no one is coming to save us.
But we can take control. We can have a more secure, stable financial future. And that's the whole premise. That's the whole idea behind getting self-directed. The mantra. It's not just the name of our business. It's not just the prefix for a 401k, our favorite type of 401k. It's not just a product. It is a mindset. It is a lifestyle for us anyway, in taking control yourself one step at a time and making sure that you are directed towards your goal. But first, you got to know, what's the goal? You ready to come back over? I think we're
Yeah, let's do
good
it.
with questions.
Do it.
We have we have a couple more. I can use the all-in-one velocity banking with the new house and wife. With the new house, my wife and I will build. I was like, did you get a new wife? New house, my wife. New house, new wife. And I will build in a couple years and turn my current house into serious cash flow.
So,
Well, you know what? When you get financially free, you do get a new wife, by the way. Wives get a new husband because of the stress is different. It's not the same.
we don't traditionally, not traditionally, we don't promote a whole lot of products on this channel. People ask me all the time about HELOCs and banks and who and where to get them from. And Usually my response is all banks can do it. It's just whether or not they choose to. So it's do your research and pit them all against each other. Don't just settle. And when you find one that you like, then you go to another one to see if you can outperform it or beat it. Yeah, it depends. It absolutely depends. And so when I hear all in one, when I hear CMG, my radar goes off. I like their product because it is designed for velocity banking. It is designed with a sweep account, like all of those great and wonderful things. Is it worth the cost is my question. I'm not saying it's not a good product, but is it worth the cost? And is there a product out there that can do the same things, but it not cost as much? And so in some cases, I do know CMG will do it. Like they have a great product. I get it. My only challenge is don't stop there. Continue investigating, continue peeling back the layers. I had a conversation that I've never had since I've been doing this with a banker this week. Kara Miller from PNC called me. And I think there's a video out there where I mentioned her name. And I guess some of you have heard it and you guys have been working with her. And it was an enlightening conversation because she was walking me through the PNC product. I'd never really peeled back the layers on. I understand what they offer. I know they don't offer us. It's not a true sweep account. What it is you have to transfer funds from your checking account from your income into the line of credit. But at midnight, any expenses are swept into the line of credit. So it's a sweep of expenses, but not a full-on sweep account. So they don't have the automation that everybody else has. But here's my point. The fact that they are working to improve and build a product that is designed so that you guys can be successful, I thought was pretty powerful. So my point in sharing that is there are a lot of companies out here like First Lien HELOC, First Savings. There's a lot of companies out here that are focused and working on trying to provide a product. I just wouldn't settle. Do not settle for the first one you run into. Take the time to do your homework, peel back the layers, ask the questions, do the interview them. They need you more than you need them. So interview them, have those conversations, and then decide is what I would say.
All right, let's bring it back over here then.
All right, do I need to run now?
Yeah, you got to hurry up. You got to beat the thing.
Oh,
And you made it.
I always do.
Well done. I'm always cheering. We got to cheer him on. Hoping he makes it each time. It's like a new game for us.
Might get lost.
Yeah. Okay, so we talked about fees, we talked about products, we rabbit holed into how this shows up, this concept that people are afraid of, how it shows up in other products, and how we can start to shape our mind around to be able to identify where else am I saying, oh no, I'm not going to do something because it has this surrender charge, or I'm not going to do this because everybody else opts into something and this looks like it could be a little bit more risky. Why would they do it? Maybe asking why would be a great place to start. Just because why would they have the audacity to have a restocking fee, right? What is it about this product that gives them the confidence that somebody would have to want to do this or be so discouraged that they would have to say, well, how are other people using this then if they're not returning it? Or if something is so easy to return, then you have to ask yourself, why? Why are these policies imploding? And that's why this is what they're riding with. Hey, look, if your policy ever implodes, when, it doesn't cost you as much. Look at that. We've already all gotten paid. And that's what caused it to implode. But hey, it's not going to cost you as much if you decide to return it, right? So those are some of the questions that I feel like are super important coming out of this. One, can you identify where your fees are on your policy? That's one of the aha moments a lot of people have is they go, what fees page?
Right.
Like off the top, Are we supposed to have a fees page? The answer is
Absolutely. A matter of fact, think about it. All life insurance products are really designed the same. There's really not much difference. There may be additional levers added, but as far as the flat structure of the policy, they're really all designed the same. So the question is, why wouldn't I have a fees page? Like, why shouldn't I be able to see where my money is going? I guarantee you, once you start the policy, you're going to get a statement. Guess what that statement's going to say? That statement's going to say where all your money's going. So why wouldn't I have that up front? Right? It's because that upfront charge is going somewhere. And if you knew where it was going, you'd question that. And I think it's intentionally kept from you. And the document that you received is probably 40 pages in length. Who's spending the time to go through those 40 pages to understand what each one of them is saying? So they're hoping you don't question what is or what isn't happening inside this policy. That's the reason why the illustration is structured the way that it is.
yeah, and forcing people to go find answers, because what also could be happening is that the person who you're asking, like, hey, where's my fees page? They're going, yeah, why don't we put a fees page in here? So they're asking their higher up. Their higher up is like, we don't want to make it seem normal or abnormal that one's not in here. So this is how we lay it out for people why there's not a fees page.
Right.
And then they go, oh, right, that just makes sense. But deep down they're going, that doesn't actually make sense. But they don't have a choice at this point. They have to tell you what was told to them to tell you. Well, we just have to stop hyper-normalizing this type of behavior. And when people start to learn and understand, like, nope, I want a fees page, they're going to have to give you a fees page. And then they can't give you a reason why it's not in there. And they can't give you a reason to not pay attention to it until you then do the math years later. I think that this is a good thing. I think it's a good thing. It's not to shame other people, because I think that when agents felt like this was the only option, that everybody was doing this, doesn't matter where they went, everybody was doing this. It wasn't until somebody decided and they said, we're not doing that anymore. We're going to be different, because this could be a really great vehicle. This could be a very effective vehicle to really help people if we stop doing all of this other BS that's causing these policies to not be impactful. I mean, and at the core of it, that's
Absolutely.
what happened, right?
Absolutely.
And so there's a lot of people bucking, I think, because they feel ashamed. I feel they feel ashamed. I feel that they want to talk down to it. I want to believe that they don't want to lose out on making as much money. I want to believe that they are looking at it from what am I going to lose by this other thing being out here, and by people being aware that this thing is possible? What am I going to lose if they understand now how much I get paid from their policy? What am I going to lose if the relationships that I built, now I've been exposed that I generated something, I sold them something that benefited me first? When the people had no other option, it didn't matter. This goes for financial advisors too, right? But now we have more control, and that's a good thing. That's always a good thing.
But I also think, again, there's many ways to look at it. If that's me, if I've been in this industry 15 years and the products that I've been selling or have sold were structured similar to what I've kind of walked you through today, and I sold them because that's what I had available to me. Those were again, I didn't know what I didn't know, but when I learn it, the easiest thing to do is to shift. And why am I here? What is my purpose? What is my goal? My goal is to make sure my clients are taken care of. And when I learn something, I give it. To me, if I'm the agent who didn't know what I didn't know, offering a product that maybe I have now learned is inferior, my objective is to right that ship.
Yeah.
It takes accountability.
Yeah. And that's okay. And, we've seen people doing that with their communities, and I'm talking big communities. And there is something that is admirable about someone who's willing to say, I made a mistake and I don't want you to go down that road anymore.
That's it.
But there are so many people who are not willing to do that, not willing to do it. And that's unfortunate. whether if it's for pride, ego, or profit. I don't think it matters. I think the purpose of being out here, and if you are in a position to uh, influence in any regard other people in their future, but you are not tied to their outcome, there is a heavy responsibility there, because there's not a single person that can go back to any of the people who are um, influencing in a particular direction for their own benefit. And come on, I'm not just talking about this industry, I'm talking about everywhere. You can't even
Right.
go on Amazon and trust those reviews now. It's a horrible place to be when you're going, who do I trust, when just feel like people are anywhere trying to sell me something. And this lady wrote this horrible raving review on this horrible product, clearly because she just wanted it for free. Like it was worth that $12 or $30 to her to scam everybody else out of it, right? And that's where we are. I was going somewhere with that, and then I just lost my thought because I would keep trying to remind myself to go back to
Comments.
his question. Yeah,
It's all good.
yeah. The point is that they're not tied to the outcome. I couldn't go back to the lady in Amazon reviews and go, I bought it based off of your review, and so therefore now I got it and realized it is not what you said it was, and you lied, right? Not tied to the outcome. If it gave me a rash, she's not paying for my doctor's appointment, dermatology appointment, whatever. And neither are any of these people. The problem is that you're not going to find out, you're not going to get your rash
Until
and
it's too late.
your financial rash until 20 years down the road. Like, where are these people even at? Could you even find them? That's where understanding the strategy, having control, and feeling like you're in control and not being at the mercy of other people is so important. And you can do it. You don't need a software. You don't need a course. You don't need a special book. You don't need any of the things that you have to pay for. You can get it all. It is all available. And I promise you, you can do it. If I can do it, I believe anybody can learn this. And you don't have to be a genius to learn it either. You don't have to be good at math, whatever the thing is that you believe that is keeping you from where you are now to being completely financially stable and confident, financially confident in your strategy, knowing that the steps that you know you can take, that you have access to information on the next steps that you could take, that you have access to a community of people who you could go, you know what? This is what I'm working with. These are the variables in my equation. Show me what you guys think the next step is that I could take. And let's work it out like a group assignment. And we should all be striving to have that so that we can all level up, because we grow farther and faster when we grow together. And we truly, wholeheartedly believe that. Rapid Rhymer says at 53 years, only a few compound cycles left, I think is what he means. Talk about how to get better or shorter compound cycles.
Yeah, and you're not going to get a whole lot of sympathy from me because I'm 52. I'll be 52 this year. So we're in the same boat. And here's the point. Right. We don't have as many compound cycles as, let's say, my 20-year-old. But what that means is we have to be a little bit more aggressive. And here's what you and I definitely do not have time for. We don't have time for loss. We do not have time to F around and find out as it relates to this economy and then all of a sudden lose 40% in our retirement to now it's going to take another 17 months or 48 months or 64 months for us to recover to just get back to the position that we were originally
break
in,
even.
to break even. Like we do not have time for loss. So it's about security. And the other piece we need products that have a shortened compound cycle. So you're spot on. So where? You got to get on my calendar and let's discuss it. Because the truth is, if it's not a properly designed cash value life insurance policy, or if it's not you open and willing to take action outside of the market. So it's, is it real estate, land, subject to, like, is it something external? So then the next question becomes, well, are you liquid enough to be able to do those things? And what is it going to take to be able to get you there? So I think the first step is let's get on the calendar and let's discuss it.
And to do that, go right here. Just right there. There it is. That. Wait. That was perfect. All right. If you are confused at all about this, you want to call and just say, hey, here's my policy. Can you do exactly what you did in this live stream? But can you just do it with my policy?
Do it all the time. I do it all the time.
Just book a call.
How about this? People bring their life insurance agent on the call. They will bring their policy and the agent that created it, and we will just make it a party. Because I'm about structure. I don't really care who created it. I don't care why it was created. Because a lot of times I'm dealing with agents who just didn't know.
Right. Yeah.
They
right.
didn't
It's
know
not
even
right.
look where I showed them to look. They didn't know the formula that I provided to be able to produce the initial expense up front. They didn't even know in some cases. In others, there's predators out here. That's just a fact. But so I'm open to it all. I'm open to discussion with you, discussion with the guy that created the policy for you. It doesn't matter to me. Your mom, bring the kids. We can do the uncles and friends. It doesn't matter.
Oh, you had one guy that he was getting his wife and her friends and sisters all together with a bottle of wine and Donnell on Zoom on the TV. That sounds like a vibe.
Okay. So the issue was he got on a call with me and he was concerned because his wife would not get on board with these strategies that we talk about. And he had no one to fight for him or these strategies because when his wife and her friends get together, he's just the silly old man. And they laugh at him and drink wine in his face. And what I offered was, hey, let's get on a Zoom. Let's make it a wine night. Let's get on a Zoom, put me on the TV in the living room, put them all in there and let them fire away. Let's talk about it.
Yeah.
Let's peel back the layers.
Well, and I hope they have snacks too. I would like to come. I would like to
open
come
to
to
it,
those
man.
types of nights. I'll go over on their side though. That way I can hackle.
I'm open to it.
I can haggle and cackle with them on their side. How can you? I want to just add to this though.
Mm-hmm.
53 years old, only a few compound cycles left. How do you get better, shorter compound cycles? You cannot. You can shorten a compound cycle by having a better return rate.
Well, okay, it's simple math. You can shorten a compound cycle by either adding more cash flow or reducing the risk. Like, so you reduce the risk, you're able to increase the amount of performance in the product that you have, which shortens the compound cycle. So it's really just mathematical.
Okay, but let's say rapid rhymer am I saying that right? Is it reamer? People are like, she can't read. You know what? But does she look financially free? Okay. If you're thinking to yourself, I need to do this to leave a legacy. This is often a comment that gets made when someone is going, how can I build enough fast enough that I could live off of it and give some to and have a legacy to pass down? This is where the family bank conversation comes into
Right.
play, where you can leverage, what's the word?
Oh, insurable interest.
Insurable interest. There it is. I know we've been on here for a minute. Insurable interest would be where this conversation starts to shift because now you are leveraging again
Where's your
completely
leverage?
different. Yeah.
Where's your leverage located?
Right. And that's where you're able to kill two birds with one stone. That's just not a nice sentence to say. Yeah. Why are we killing birds? Anyway,
Yeah.
Who's doing that?
Sometimes they need to die.
You're making 2 points with the same. Okay.
It's time to go.
It is.
It's time to do.
The point is though, is getting the biggest bang for your buck and being able to extend the terms that your money can grow. That's really what we're talking about here. And when you're thinking of doing that and involving children, being able to utilize them. For some people, when I was doing the math in the beginning, when I was just trying to learn to understand, do I understand this? Because he knew all about it and I was the cackle and the hackle at you, right?
It got pretty heated.
Yeah. And I did not believe, I was not on board. I was not a believer. Point is that when I first started to understand this and I would create these scenarios and go, okay, if somebody was this, and this, then could they do this, right? Do I understand how this could be applied here? One of those was an 79 at the time. And I was coming up with a way that she could, if she had to quit her job with the assets that she had, if she had to quit her job, could no longer trade her time for money because there's some health concerns and whatnot. It was somebody new. And I was trying to find the fastest way to retirement income, enough retirement income to sustain her. And the way she could do that was, instead of utilizing herself with her age and her health issues, it was by leveraging
Her daughter
or grandkids.
Yep.
Yeah. And doing it with insurable interest, doing it in a way that just funneled the money in a different way. It doesn't matter. And I was able to do that and give her an exit. Like, I can get off on this exit as long as I do A, B, C, and D for this next 3 years. 3 years. 3 years. And she could have had tax-free income for the rest of her life and handed her grandchildren these machines that she had built for them that would continue to compound. So you want to talk about how can you better shorten compound cycles? How can you exponentially grow those faster so that those compound cycles are doubling with larger amounts of money in them? Start them younger. That's how, because if they stop with you, then how are they going to keep it going, right? So you might as well start compounding younger as soon as possible so that those compound cycles become significantly bigger over time.
And that's the and conversation, right? It's not this or that. It's where's the leverage located and how can you put it all to work?
Yeah, because what does this look like when your kids or your grandkids are 40 and 50? What does that look like? What does it look like if you just decided to pack up and leave and not even like stay here, right? What does it look like if something happens and you can't trade your time for money? That's really the conversation. And the question to ask is, how can you just be insured that you're okay if that happens? Not because of a writer, not because you have to have permission, not because you had to submit paperwork to get it approved, but because you've become your own bank in a way that it doesn't matter. They can't tell you no. That's the question. How do we get to that part? We got to that part, and that's what we're helping. That's where we're helping you go as well. So on that note, let's
get out of here.
Yeah, I think we're good on
It's dinner time.
questions. Yeah, people are Gabo saying the chickens are birds too, and they're delicious. Oh my goodness. All right. Hold on a second. Okay. We like to end with, and thank you all so much for your time. We haven't done this in a minute, and it does feel good to kind of be back. So if you maybe we'll be able to do these more often as we were Sunday and Wednesdays before. Okay.
I like it.
Yep. All right. We like to end with, if you didn't come from a wealthy family,
You can make sure a wealthy family comes from you.
so stay tuned,
Stay protected.
stay focused.
Stay connected.
I'm Angelique,
And I'm Donnell.
and our goal is to help you.
Get self-directed.
And to do that, we have a ton of free resources, and we're working on more every single day. We hope to see you right back here. We will be back here on Tuesday next week at the same time. We hope to see you then.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get self-directed.
Self-directed.